Marhaban, Assalamualaikum, very good morning. Welcome to ACCY112 lecture for week 7, I think. We're going to discuss a new topic today that is non-current assets, acquisition and depreciation. Al-antum jahizun? Falnabda, let us continue. I think every one of you are ready. So today I'm going to cover a few things. That is number one, I'm going to explain about what is meant by property, plant and equipment, the PPE, and then I'm going to compute the cost of PPE. How to calculate the cost of PPE? Okay, this is clearly we are going to discuss this in detail in EKI 200, relevant accounting standards. But in this lecture, I'm going to give you some basic idea how to determine the cost of property, plant, and equipment. Number three, are we going to apportion the cost of lump sum payment for multiple asset acquisition? Describe the basic of the acquisition of asset under lease agreement. Discuss the nature of depreciation. This is the most important parts in this lecture, that is how to calculate depreciation using different methods. Okay, and also subsequent costs related to the property, plant, and equipment. Maybe there are enhancement of capacity. You repair the asset. So how we are going to account for this? Maybe you renovate or enhance the capacity, or it's just a normal repair. So how we are going to record these two types of transactions, and then record property and plant records in the property and plant subsidiary ledgers. And I'm going to illustrate the reporting requirement for PPE, okay, and analyze and interpret information on PPE, property, plant, and equipment, and appreciate the critical nature and importance of management decision in relation to property, plant, and equipment or non-current asset in this context. So, what is nature? What is the nature of the property, plant, and equipment? It's always a management intention to use this asset for future production of goods or services or over a several accounting period is the main factor that distinguishes them from other assets sold to an income. For example, if you have a delivery van or motor vehicles, so you're going to use that assets for more than 1 year, maybe for transfer of goods from one location to another location, or use it as your employee transportations, yeah, for employees transportation. So the benefit is for more than 1 year. So in that case, that delivery equipments or vehicles should be classified as your property, plant, and equipment as non-current asset. At the same time, if you are involved in selling and buying delivery equipments or vehicles, that item will be classified as inventory, as a current asset rather than property, plant, and equipment. So the future economic benefit contained in the PPE will be received over 2 or more accounting period, maybe more than 1 year, 3 years, 4 years. If you bought a building, purchase a building, so you're not going to sell that building next week, you're going to use it for a very long period of time. So that building called under property, PPE, under property. So because of that, when we incur a lot of costs for non-current assets, and we're going to enjoy the benefit for a long period of time, so we need to depreciate. We need to allocate the cost systematically over the useful lives. For example, if you buy a car or van, yeah, for 100,000, and that van can last for 10 years. So you need to allocate the cost for 10 years period. So you have to divide the cost of that van for 10 years period. I think every one of you have used the Dubai taxi, the halal taxi in Dubai. They use this Toyota Camry as their taxi. I regularly use this taxi before this because I don't have my driving license. So when I check with the driver, normally they will have a very high mileage for the taxi. Yeah. For this Camry, for ordinary people like me, we can use the Camry car, Toyota Camry car, maybe for 10 years or 15 years because that is highly durable, long-lasting car. But for the taxi, since they use it non-stop, I can see that after 3 years, the mileage is already more than 400,000. So I was told that maybe after 3 years, they're going to dispose their assets, and then they're going to change with a new Toyota Camry, the new one with the hybrid model. So the useful life for Camry, for maybe for the Hala taxi, is only 3 years because the usage is very high. So they need to allocate the cost for the company. They need to allocate the cost of the taxi, buying the taxi, depreciate over maybe 3 years period rather than 10 years because the usage is different. So you can see that from here that the allocation of cost might vary between one company to another company. So in order to determine the acquisition cost of plant asset, the entity must measure fair value of the item it has given up to acquire that asset, not the fair value of the asset which is being acquired. What does it mean? Is if you buy a building, if you buy maybe a villa, we have many big villa in Dubai. You buy a villa there. So we are not looking at the value of that villa. Maybe the value of that villa is 5 million dirhams. We're not going to record 5 million dirham, but we are measuring what is the fair value of items or cash payment made to buy the villa. Maybe you buy the villa at price of 4 million. So you're going to record that villa, that property at price of 4 million rather than 5 million. So that is what it means by the fair value. It is mean by the fair value of the item it has given up. In order to buy the assets, you have given up cash, maybe, cash that was 4 million. So rather than the actual value of that asset may be higher or lower than that. So the fair value is the price that would be received to sell an asset or the amount paid to transfer a liability in an orderly transaction between market participants at the measurement date. So we're going to use the fair value or the price that will be received, by the seller. Okay. So in determining the cost of property, plant, and equipment, care must be taken that only reasonable and necessary expenditure are included. Okay. When an entity constructs an asset for its own use, the acquisition costs include all expenditures, including the labor, material, insurance during the construction. What it means here, if you bought a piece of land, this is your piece of land, you are building your tower here. Okay. So the main expenditure will be the material, maybe the land, the cost of land. This is the cost of land. Okay. To construct a tower, you need the materials. The material, maybe all the bricks, all the cements, all this maybe, I'm not sure, irons, steels, or whatever, concrete. So you need to build. This is all the material. And then on top of that, you're going to pay labor costs. Maybe, I'm not sure in Dubai, but in Malaysia, if the material is 100,000, I just put one number here. Maybe the labor cost is also 100,000. So that is the real formula, 200,000. And the margin might be another 200,000. So you are going to pay 400,000 if you buy a ready-made building or valuable building, because this is the material cost, this is the labor cost, and this is the profit taken at, or the margin, the margin of the developer. So all these costs should be included as the cost of the property. When we talk about the property, it incurs all costs related to the construction, such as labor. If you need to pay Yeah, I'm not changing. If you need to pay the material, so you're going to pay for the material, insurance, or whatever cost incurred in constructing the building. So for that is for the construction assets. A qualifying asset is defined as an asset that necessarily taken a substantial period of time, usually longer than 1 year, to get ready for its intended use of sale. So this is what it means by qualifying assets. In a lump sum acquisition, several items or property, plant, and equipment may be acquired for a lump sum payment without an identification of the cost of each asset. Okay, so according to the IFRS number 3 or ASB number 3, business combination, when the lump sum acquisition does not constitute the acquisition of the business entity, the cost of acquisition may be allocated on the basis of the fair value of acquisition date at the asset of the assets acquired. So in this example, for example, we have three towers. We have many towers in Dubai. We have this tower A, tower B, tower C. You're very rich guy, yeah. So you bought all this tower, a lump sum payment. Maybe you paid 500 millions. So in that case, we are going to use the fair value of assets to determine each value of this building, the tower A, tower B, and also tower C. So this is when we have these lump sum acquisitions. The entity leasing the asset is referred to the lessee. This is another one, is leasing, and the supplier is called as lessor. We're going to study the accounting for leases, yeah, in ACCY 200. If you want to study more, you can watch the video. It's available on YouTube, okay? So operating lease is one where the lessor effectively retain substantially all risk and reward attaching to the ownership of the lease asset, whereby a finance lease is where the substantially all those risks and reward are effectively transferred from the lessor to the lessee, even though the legal ownership remain with the lessor. So this is a very advanced, yeah, topic for you. For example, we have now for a company like Nissan, yeah, the car manufacturer, they provide the lease agreement. What is the lease agreement? Whereby you can lease this Nissan car. Maybe I put here the Nissan car. This is just an example. I think all automotive company, they have this one. Okay, this is Nissan company. You can sign a lease with them maybe for 5 years. Before 5 years. So during that period, they will give you the car, the vehicles, and you need to pay them every month a sum of money. So the car still belong to Nissan, this company, this car, yeah. So I need to ask Nissan to pay me some advertising cost here. So Nissan will give you the car, okay, and you're going to give them the money. So in terms of ownership, it still lies owned by the car is still owned by Nissan, but you have the benefit, you enjoy the benefits. But the benefit, what I call here is right to use. Right to use. You can put this in your assets. And then you also have your liability. So this is your lease liability. This is your lease liability. You don't have the asset, but you have the control over the assets. You can use the asset. You have the benefits from the asset. So that's why we can put it as our liability. So we can divide into two, whether it's operating lease or the finance lease. The finance lease is when, okay, the reward and risk are transferred from the lessor to the lessee, to us. Yeah, even though the legal ownership remain with the lessor. So this is a complex topic. If you want to study more, please watch my YouTube on this topic. It's available on YouTube. Yeah, the videos. Okay. Next, we move to depreciation. What is depreciation? This is the most common question for your junior. Yeah. So depreciation is allocation of costs associated with the non-current asset, specifically the property, plant, and equipment, where we're going to allocate the cost over the estimated useful life. Okay, so four factors which contribute to depreciable asset having limited useful life is number one. Okay, why asset have limited useful life? Number one is the expected usage of the assets. I did mention about the halal taxi. The taxi run non-stop 24 hours a day, 7 days a week. So after 3 years, they're going to dispose the asset. The expected useful life may be 3 or 4 years. Yeah, 3 years, I think. Okay. So it depends on the usage. You cannot use the same car for 1 million kilometers or miles. It has some expected useful life. Because of that reason, the more you use the assets, the more depreciation you have to incur. Yeah, you have to incur. So that's the formula. Number two is the expected wear and tear through physical usage in excess of that which maintenance can restore. So this is the reason why we have to provide depreciation. The next one is technical and commercial obsolescence. What does it mean? If you buy one phone, I don't want to mention any phones because they're not paying me. If you buy one phone, the model 13, for example, after 1 year, they come up with another model, version 14. So what happened to the price of your phone version 13? Suddenly it will go, the value will go down. So right, will go down. Next one is legal or similar limit on the use of asset such as expiry date of leases. You sign the contract with the manufacturer company, the automobile company, you're going to lease for 5 years. So after 5 years, you're going to return back the car. So that's why you have to provide the cost, the depreciation for 5 years. So determining the amount of depreciation, it depends on the useful life of the assets. The period, what is useful life? The period over which an asset is expected to be available for use. Okay, or it depends on the number of production or similar unit expected to be obtained from the asset by the entity. Maybe one machine can produce up to 100,000 unit. After that, you have to write off the asset. So the useful life is the period which asset is expected to be available for use. Okay. What is residual value? Residual value is the amount left after the estimated useful life, where you can sell the assets to the uh, to the maybe to the recycle center or whatever, to the, so that is also refers as the salvage value or trade-in value. Maybe the asset cannot be used anymore for the car, but you can sell the car to the junk collector. Maybe they will pay you some of money. So that is what we call as the residual value, or sometimes we call it as salvage value. Okay. So how to calculate depreciation? There are many methods to calculate depreciation. The first one, the most common one, is straight line method. Straight line method is the easiest method. That is, you're going to allocate equal amount of depreciation to each full accounting period in the asset's useful life. Yeah. So that is the straight line method. Let me give example. If you buy one asset, this is your accounting year. Your accounting year okay, from 1st January until 31st December. So this is your accounting year. So now is, for example, 1st July. On 1st July, you buy one van, delivery van, that costs you 100,000. Okay, and this one has expected useful life of 10 years. 10 years. What does it mean? For every year, you're going to provide depreciation 100,000 divided by 10 years. So your depreciation, annual depreciation is 10,000 per annum. Per annum. So you purchase this van on 1st July, on 1st July. So for the first year, so from 1st July, when did you close your account? Until 31st December, this is 6 months. 6 months. So 6 over 12, 1 year, multiply by 10,000. So depreciation for the first year is only for 6 month period. So the amount of depreciation will be 5,000. Okay. Or because 10,000 is for one full year. So 6 months, 1st July till 31st December is 6 months. This is 6 months. So how to calculate this depreciation? 6 months, divide by 12, multiply by the 100. So what is the annual depreciation? The cost is 100,000. Okay, divide by 10 years. 10 years. Or you can multiply by 10%. Or you can multiply by 10%. So this gives you 5,000. Okay. Okay, let me repeat again. Yeah. Okay, this is just an example. You purchase one delivery van on 1st July. The van cost is 100,000. Based on your judgment, you expect that the van will have a useful life of 10 years. So you cannot put this 100,000 in your income statement. This is not the cost for 1 year. The cost is for 10 years. So in the first year, you're going to put in your income statement only 1/10 of it, or a portion of that, okay, as your depreciation. So your annual depreciation will be 100,000 divided by 10 years. So your annual depreciation for every year, you're going to provide depreciation for 10,000. Second year, another 10,000. Third year, another 10,000 until you complete all the depreciation amount of 100,000, until your accumulated depreciation become 100,000. So in this example, you purchase the asset on 1st July, So from 1st July until 31st December, it only covers 6 month period. So you shouldn't provide depreciation for one full year. You shouldn't provide depreciation for one full year. Okay, so you need to provide depreciation for only 6 months out of 12 months. That will be 0.5 multiplied by 10%. So this is the formula. 100,000 divide by 10, okay, multiply by 6 over 12. So this gives you annual depreciation of 5,000. Or another way of doing this is you can also use the percentage. Okay, the percentage. Okay, what is the depreciation rate? What is your depreciation rate? Depreciation rate is equal to 100% divided by 10 years. So this gives you 10%. So every year, the asset will depreciate by 10%. Every year, the asset will depreciate by 10%. So you can do this, multiply by 10%. So it gives you 5,000 for the first year. Yeah. And then you're going to have 10,000, 10,000, 10,000, 10,000, and last year will be only 5,000. That is for the 6 month period. Okay, so this is the straight line method. Method number 1. Okay, now we move to the second method, that is diminishing balance method, or sometimes we call it as reducing balance method. Another name for this is reducing balance methods or declining balance method. So under this method, the diminishing balance depreciation method result in decreasing depreciation charge over the useful life of the assets, and the amount of depreciation is greater in the first few years of the useful life and become smaller till the end of the useful life. So to determine the rate, we have this formula. The rate of depreciation is equal to 1 minus square root of n r over c, whereby r is the residual value, okay, c is the original cost, the value amount in dollar, and n is the useful life of the asset, okay. So this is the formula. So you have to remember this formula. If for straight line method, this is your year 1, year 2, year 3, for example, the amount of depreciation is equal. What I mean equal is they have same amount, 10,000, 10,000 for every full year. Yeah. But for depreciation using diminishing method, valid method, the amount of depreciation is higher in the first year, yeah, reduce in the second year, reduce in the third year, and reduce in the fourth year, reduce in the fifth year, and continue. So this is what I call as diminishing balance method or reducing balance method. And the calculation is not based on the cost, but based on the carrying amount or net book value. I'm going to show you the examples, yeah? We're going to do one question afterwards, okay? Another technique is by using a sum digit method. This is very interesting method. We're going to provide depreciation based on sum of your digit method. It's a different way of applying diminishing balance method in decreasing depreciation charge over the useful life of the asset. So this is interesting, yeah, whereby you're going to assign the number of years, yeah, for every year, and you're going to sum the years, and then the first year, the first few years will be high as well, but we don't use the percentage as what we did before using the reducing balance method. So depreciation for each period is determined by multiplying the recorded cost less residual by the successively smaller fraction. So this is the method. I'm going to show you this method. Okay. Number 4 is by using the unit of production method. Okay. The unit of production method relate to the use rather to the time. You use more, you provide more depreciation. You use less, so less depreciation. Is based on usage. Yeah, based on usage. Maybe based on operating hours. So for every asset, you're going to estimate the maximum operating hours or usage. The operating hours or usage. And then from there, this will be the base in calculating or providing depreciations. So